All right, welcome back. Dr. Hassan Mahmud is joining me right now. He is the Director of Monetary Policy Department at the Central Bank of Nigeria. Good morning, Dr. Mahmud, and thank you for joining us today.
Thank you. Good morning.
I know that this period is always a busy period for you. Yesterday, or most MPC meetings, when the governor is reading out the communique, your eyes, I always take a look at you across. Your eyes are always like,
looking line by line.
Yes, reading like that. I hope our guys reading line by line. So welcome to the program. Where should we start from? And let me start from the aspect of the 16.5% rate hike. I asked a few analyst questions yesterday. I had Professor Kenife on the show yesterday. I asked him what his prediction would be. He actually said, Nancy, that the CBN will raise interest rates. I spoke to a few people. I was like, why? I was like, don't you think they will hold this? He gave me why they would increase. Then some people said, no, I think they will go for a hold. Do you think that this rate hike surprised the market, at least from what you all have heard after the meeting yesterday?
I think I also had a few of the predictions, and largely, I think majority were thinking the committee will hold. Will increase rates. The developments both within the global and the domestic economy is a kind of mix. For those that think we should hold, I think they have valid grounds. For those that think that monetary policy is supposed to hike rate more, I think they also have valid ground. And this debate actually played out in the Monetary Policy Committee meeting proper. There was a divergence among the members at the initial analysis of the economic development. The justification which the governor read out in the Monetary Policy Communique was the fact that, yes, inflation numbers are still rising. The global fundamentals, the global developments or shocks that were impacting Nigeria, Russia-Ukraine war, tightening in the United States, normalization that is going on, tight international financial market, commodity prices, what is happening to the oil prices, between the last MPC and this MPC still remain the same. In some cases, even worsen. In the domestic scene, inflation numbers are still going up. The tightening that we're seeing in terms of government finances, it was still going on. We also see new shocks coming in, the flood, and how that is also impacting on food production. So even within the domestic economy, there are still huge uncertainties and factors that are still kind of headwinds to driving growth and taming inflation. So yes, the committee noticed that month on month, inflation numbers have started coming down in the last 3 months or so. However, year to date or year on year, inflation numbers are still increasing. We had 20.77, now we have 21.09. So year on year, inflation numbers are still increasing. But if you look at it month on month, the rate of increase in inflation number is now decelerating. If you compare it to what we had April, May, June, July, we are having like 100 basis point, over 110 basis point increase month on month. Then suddenly we start having 20, 30 basis points. So the analysis of the members were the fact that yes, the tightening we're doing is gradually yielding results. They're also conscious of the fact that there's a lag effect in terms of the impact of the actions that you took in the previous period. So you allow you to smoothen into the system to start having the maximum, or what we call the optimal outcome. There are also new challenges that are also still affecting the inflation number that they are trying to tame. Don't forget that both core and food inflation also increased even within those periods, albeit lower than or moderated compared to what we had in the period. So members and governor actually emphasized in that meeting, guys, do you think what we're doing is the right thing? Are we really making it? I want all of you to speak to this.
At the meeting?
At the meeting, yes. He emphasized that they took more than 3 hours, debating on, are we doing the right thing? We have 4 or 5 professors there. We have PhDs there, economics. So let's deliberate on this. And it was it was unanimous, was consensus. Yes, we've done the right thing. It's not just a bad bargain effect because everybody is increasing rate, we also increase rate. No, the rates that we increase are a function of what is happening in our economy, and we're seeing the results, but the results will take time. So let us consolidate, let us be consistent, let us maintain the tempo until when we start seeing some reasonable numbers before we start taking the leg of the pedal. So that debate went on, and it was seen that yes, inflation is coming down month on month, year on year is still high there. The threshold we are looking at is still far away from the threshold. If you are looking at inflation of single digit or just above single digit, and we are doing 20-something%, we are still very far. If you compare that to even the MPR that has been increased from 11.5 to 16.5 to date, you still see that the gap between that 16.5 and 21.09 is still wide. So the negative real interest rate margin is still very wide. And you need to narrow that to be able to have positive real interest rates so that your money market and all other monetary policy tools that are going to apply will yield positive results. Because so as long as you have negative real interest rate, capital mobilization, savings mobilization, investment build-up will also narrow significantly, and it will also trigger capital outflows. So you start seeing distortions within your economy, your external reserve positions will be threatened, your exchange rate regime will still be faced with those volatilities or pressures that will make you to have threats of depreciation, which will also again pass through to inflation. And then you start seeing a cycle of those distortions permeating the economy, and your primary objective of price stability will not be achieved. So there was a need to be consistent, there was a need to have consolidation on what is building up, but you realize that the last MPC, the MPR was raised by 150 basis points. This time, 100 basis points. So I think as time goes on and they see this, because MPC members are also mindful of what is the impact on this on growth. What's the impact on this on poverty, what's the impact on unemployment. So yes, we want to tame inflation, but the trade-offs, you need to manage the trade-offs that come into that so that those trade-offs do not come and jeopardize what you think you have achieved. So the tightening was just the best option available now to consolidate on this, and by the time we get to second quarter of 2023, and we'll start seeing inflation coming down 16, 15, 14, yes, you see that, yes, we are getting to where we want to be, and then you can start narrowing up on the pace of tightening.
Okay, I've written down a lot of stuff while you were talking, so let me take you on that. First of all, let's start with, I would like to know how the central bank's MPC really study the impact of the permeation of the past interest rate hikes. Yeah. And I heard you clearly when you said the governor asked his colleagues, guys, are we doing the right thing? And they used 3 hours to deliberate. But I really want to know how it's being really studied to know the impact of that permeation, the transmission mechanism, that if we raise rates or whatever decision I would take, the permeation of it, that's one. Then number two, is 2 months enough really to see results? Because it's 6 times a year, like every other month. The last one was done in September, this one November, the next one January. So is 2 months really enough to see the impact? Because this is the 4th rate hike for this year. So if, as the Central Bank of Nigeria says, that, oh, guys, we are seeing results. If you're seeing results, you should be able to have seen results like in 2 months, supposedly, and you know how to. Dr. Mahmud, I hope you understand.
I understand very well.
Yes, my question. So let's take those two first.
Yeah, in terms, you see, when we do this MPC, the members do this MPC meeting, we have 2 key presentations. One on economic report. The economic report is highly technical in the sense that there are a lot of models, a lot of simulations, there are a lot of forecasts that go into those models, there are a lot of statistics that come into that. Even the Assistant General of the Federation is in the first day of that technical meeting and also gives some brief.
Oh, he comes
He
to
comes to the MPC meeting.
Oh, really?
The first day of the MPC meeting.
Okay.
He actually speaks at that MPC meeting.
Oh, the Statistician General. Not that you get their reports from NBS and you discuss. He must come there.
He comes there, discuss the numbers, also give us their own projections on how things will look like. Some of the numbers we see, he gives explanation to that. So on the central bank side, we have a lot of staff estimates and simulations that goes into that model. The bank, the MPC has also commissioned the researchers within the bank to go and look at those models. If we take a decision today, how long do we expect to have the impact? We've done all those studies, the transmission mechanism, given the rigidity within that system, how fast do you think this can impact, calculate the lag period of policy outcomes. All that has been done and presented before the MPC. We also have studies that have been done to say, okay, if we want to, what we call it sacrifice ratio.
Yeah.
You have to give up some things for that.
Something must
so
give.
What proportion should we be able to give up to be able to still have, some optimal outcome in terms of the growth numbers we're seeing? And that's why I said, even though we're tightening, we know this tightening is going to stifle growth and is going to impact on the economy. So monetary policy transmission, given the fundamentals of our economy, and like Governor always says, ceteris paribus, we don't see new shocks coming in. If the situation remains the same, will take 3 to 4 quarters, before you start seeing some, meaningful or marked recovery or impact on the system. So if you do something 2 months ago, and that is why members took the decision that they took, now that yes, what we are doing will bring results, but we have not started seeing the results. But we are aware that the result will come so period in time, most likely, and we don't want to overheat the system before we start seeing the expected outcome. So if you're looking to 2 to 3 quarters, you're looking at 6 months in the period to 1 year, you start seeing the impact of what you have done. Don't forget that other factors are playing within the economy. When we're doing the demand side management, the supply side will have to complement. Even if the scenario that is always being developed is baseline scenario, let's assume nothing happens from the supply side, apart from what we have. What will be the impact of this over time? And we'll have those numbers that are coming out. Those are done at every MPC meetings. What is the forecast for, in our MPC meeting, we'll have what we call Outlook, the section of the Outlook. So we have projection for the next 3-6 months, what GDP will be, what inflation will be, what other reserve positions will be, given so assumptions, given this outcome. So we're plotting our interventions, we're plotting other development from the fiscal, we're plotting other expected shocks from the global economy to simulate that scene and have numbers. So those numbers are what the MPC members work with. So it's not just like, a lot of intuition comes into it, but the intuitions come based on the numbers we are seeing, the statistics we are seeing. So it's not, what I'm just trying to say is that it's not like a guesswork. Let's do this and see what comes. No, we already have expected outcomes. When you are not getting the expected outcome, you will see the reason why, or what you did not expect to come into that space came into that space. So what adjustment do you do for that?
So with all the decisions that has been made, at least in the last 4 meetings,
yes,
the MPCC expected outcomes.
Yes,
because inflation is, headline inflation is still high. And that takes me to the second part of, I don't know if you've landed on the first that you were explaining. That takes me to the second part, which you mentioned earlier, that we've seen a month-on-month deceleration. But an average Nigerian, or even someone watching that does not even understand the basics of what we're saying, is that if inflation is coming down month on month, why is it not reflecting in the headline inflation, as it were? You understand? Yeah. Let me just be as basic as possible.
Yeah. The reason that it is not reflecting in baseline is the month-on-month decline is not big enough to cover the year-on-year increase that we are seeing. Because what normally happens is the inflation itself is not the absolute price. It's the rate of change in the price movement. That's how we calculate inflation. It's it's a bit technical, but the point is there's a lambda sign that you put when you calculate inflation, looking at output.
The price change within a period of time.
Yes, the rate of that change. So it could be increasing, but the rate of increase differs. So the rate of, if for example, between October and November, inflation month on month increased by 100 basis points. That is from 11 to 12, for example. And then November, December, inflation still increased by 80 basis points. You will see that the 12 was equal to 12.8, but the rate of increase has declined.
Because
so
it's not 100 again.
It's
like
less.
80.
Yes,
yes, but not that prices are still not high.
Yes, they're
but
still
the
high.
rate of
As
change
it is going up,
is going down.
It's going down. So after some threshold, after some time, you will see that will now impact the year-on-year numbers, because that's what we call the base effect. We are looking at January this year against January the previous year. So you look at that in the calculation of that. But like you said, all this mathematics is not relevant. What is relevant to the man on the street is that the cost of rice has gone up. January, this amount now is 50,000. What are we doing about it? And like I said, other factors also play out. What monetary policy largely does is to address the demand side, short end of the equation. The other structural side, long-term effect that deals with infrastructure, supply, issues, and all of that, manufacturing output, growth, productivity, they are a bit medium to long-term. So you need to get all that, pushed up before you can effectively see the outcome of your demand management side. So we're also mindful of that yes, the side you're occupying is just one out of the big basket. So moderate what you are doing so that the other sides will not suffer. That's what we call Pareto optimality. What we are doing to gain does not, by extension, make others to lose. So sustainability issues are very important. So we are aware that, yes, we're having impact. The impact is slow. There are periods when we start saying that, no, these are not the expected impact that we're expecting. We have not reached that stage yet. And that's why I also mentioned that there's moderation in what we'll do, saying that the signal is already. Don't forget that monetary policy, MPR that we use, is supposed to be a signaling tool for others to take, banks to take cue from that signaling we did, and by extension, the rest of the economy, investors, households, should take a cue from that. But other factors also determine how those groups behave. But what's important is for there to be confidence in what the central bank is doing, credibility in monetary policy, and transparency in what we do. So example of this communication we do, enlightenment, is very, very key, because people will now start seeing that, yes, this is where we're going. In the analysis of inflation we do, there's what we call inflation expectation, what people expect the numbers to be. Because even the lay people are also listening to what is going on, they are seeing the behavior of the market. From the numbers we are seeing now, that inflation expectation is also declining, because the build up to the numbers you see. When somebody thinks that, oh, price will rise by next month, what is going to sell now, you build that price into it, because he knows he will go to the market to buy, to restock. So he builds that expectation. It's not that the price has really increased, but his expectation is thinking, given the fundamentals around him, given the information that he or she has, will build it up. So that inflation expectation is declining. We're seeing that markedly now within the space, and it means that there's a trust in the integrity of what the bank is doing, and expectation that this tightening at the end of it will tame inflation.
Okay, Dr. Mahmud, I have some questions here from what you're saying, and let me quickly reel them out to you, and I'll give you like 2 minutes to answer them, because we'll have a lot to cover. Now, from what you have said, there's a sacrificial cost, as it were.
Yes.
How much of growth is the MPC willing to sacrifice? 3.54% in the second quarter of the year. So how much of growth is the MPC looking at? We are increasing interest rates. This increase in interest rates will make the impact to be businesses would have to pay. There's higher cost of credit, manufacturers. You understand what I mean? The impact will be on manufacturers. So how much of growth is the MPC willing to sacrifice? That's one. Number two, this rate hike, manufacturers will definitely cry over it, because you're talking about people that borrowed money from banks and all of that. If you go to borrow money from banks now, it will be more expensive. That's Number two. Number three is, how concerned is the central bank's MPC, or even the central bank generally, since one of your core mandates is to control inflation, price stability? How concerned are you all there in terms of the price increases of commodities? The bag of rice now is higher. It's been forecast that it will go higher to over 40 or 45,000 as we approach the festive season and all of that. So take those questions quickly.
Okay, let me take it from the back.
Yeah.
In terms of how do we expect prices to go, the last question that you asked, in one of the meetings we had this morning, the Director of Development Finance explained that, because there were questions around, yes, you see flood, people could not pay back their loans, the cost of borrowing new loans is very high. Don't you think that this will now start impacting on the next level of price? We foresaw this and took certain measures, to guide against this kind of shocks coming into the system. So we had a kind of reserve, strategic reserves of grains and on rice and all that. And the point now is, by the time we start seeing those temptation or threats of prices going high because of this development, we'll release those grains into the system, and that will cushion the price. Don't forget that most of the people that central bank gives loan, some of them pay back the loans in food items or agricultural produce that are stored by the central bank in silos and at a particular price. So we also want them to gain in what they produce, so prices are negotiated ab initio, and then when those things go, we just discount it from the loans they took. So those grains are released so that price will moderate. So in his own analysis, he mentioned that, yes, we are hearing stories that rice is now getting to 50,000 or so like that. But from the negotiation that they've done, from the agreements with the millers and all that, it is still supposed to be within 30, 31,000, and there's a profit margin that is already building. This, all cost implications in that space are already built into that. And so if those agreements, and he mentioned clearly that if the guys want to take arbitrage and have a kill, you see, what this does is, this is a perfectly competitive market space. What this does is our borders are open, trade is going on, you see influx of cheaper rice coming into the system. And if you don't have grains to mill, then your business collapses. You lay off people. So at the end of it, you lose. So it's better for you to sustain the market and ensure that there's transparency and no arbitrage in the market, so that your profit, your turnover will be consistent, and your profit gain will pick up. Now, the second question you asked around whether the sacrifice level that we're looking at was a tolerable level. In the analysis that we did, and I said they are all scenario analysis. We did simulations to show that if you increase MPR by 100 basis points, you will lose 0.3% in GDP. Yeah, what threshold can you take? If you reduce by 200, you will lose 5-something%. I mean 0.5% in GDP. Because what we are also looking at, that if you lose that, how long will it take you to recover it? So it's very important. So we have thresholds, minimum thresholds that you need to reach, and the maximum threshold. So if you have a cut of 0.3, 0.4 in GDP, continue. When you get to 0.5, it's going to be inimical to further growth, and recovery will be stalled or delayed. And that will mean that you need to do more in the second round of your policy implementation to sustain that space. Whether we are concerned about the way prices go up, or cost of production for manufacturers and so, yes, we are indeed very, very concerned. But what drove that decision to tighten was that, one, there was what we call pent-up demand. Because of the injections that came into the system post-COVID, a lot of money, a lot of loans were created, a lot of facilities were extended to the general public, including the manufacturing. Those loans, if they give you a loan of 10 million naira today, it may take you a year or two before you finish your production process and start having this. But those monies are all within the system. You are paying people, you are paying suppliers. So the build-up in that aggregate demand was also fueling inflation, because so many people have those resources, to buy different things, and because there are many, what we call demand pull inflation, prices were going up. So what the tightening was to do deliberately was to slow that effective aggregate demand, they call it, to slow it down a bit so that supply can meet up. So supply picks up quickly and meet up with that, and then we have equilibrium, and then the price that you are seeing is a perfectly competitive price, which will make those that are supplying to make enough profit to pay their salaries and wages, and then what we call a break-even point, and make a profit of that. So that is important. For those that are also worried now, if you allow inflation to be going, even if your income earning increases, so long as inflation is going up, the real value of that income, disposable income or earnings, will be reducing. So the impact of that on your purchasing power will also decline. So even if you said, okay, the prices are still going up, inflation is going up simultaneously with that, then your ability to continue to pay your workers, or the ability of your workers to continue to work for you because they can't pay their electricity, pay their other charges, then will decline. So unemployment will come in. So the supply side will also collapse. That's what we're looking at. But after we narrow that, because don't forget that for you to also get cheaper loans, they have to have the deposit that will build up. When this negative real interest is large, people don't deposit. There's no incentive for domestic savings accumulation. So you have to also, because what central bank is also doing is that make sure that even within the money market or fixed income market, there's a good return to drive investments. Because if those funds don't come, you don't have what to lend, even to finance government activities or private sector activities. So we're looking at both sides of the equation. When the inflation numbers narrow substantially, then the value of your manufacturing output will also increase. The cost, because you earn those monies to spend, so your purchasing power will also improve substantially. So after some time, now, yes, it's tight. It's not even manufacturing, even the banking system, they are also feeling the pain, because the cost of borrowing from central bank is a lot higher now.
Okay.
And then they have to on-lend to the rest of the economy.
Yes, it's a lot higher, and they also have 32.5% of
CRR,
their banks.
Yes.
So it's like the banks are stifled on every side right now.
Yes.
Dr. Mahmud, we have 1 minute to go, and let me put this in. What is the realistic threshold for inflation that the MPC is thinking about? We are 21.09%. At what rate will the MPC be comfortable about? And how soon do you think that the MPC will close the gap? Because we have negative interest rate now. I think my first question also relates to the second. That's it. Then the third question is coming in from one of our viewers, and let me see. Olayemi on Twitter is saying, has there been any evaluation of CBN's monetary policy decisions in the last 5 years? So quickly take that. Okay,
there has been. We do it every time. The evaluation of monetary policy.
Do you independently evaluate, or you evaluate yourselves? Do you bring people outside to evaluate you?
The IMF, when rating agencies, when all those guys come, they are more or less doing an appraisal of the entire system. So they will tell you where this is done. In-house staff estimates are also doing it. If there's a need to tweak the monetary policy framework for effective impact, all that is going on simultaneously and at very frequent intervals. In terms of what is the threshold of inflation, yes, the guideline now is to have a single-digit inflation rate. That is what we think is appropriate for economic growth. But like I also said, staff studies and research are also going on. And even at inflation numbers of 12.5%, that is not inimical to growth. But like I said earlier, inflation of 20, above 20, definitely is inimical to growth. The speed at which you can close that gap of the negative is dependent on the fundamentals of the economy. We are just talking of overheating the manufacturing and the banking system. So that alone is a limitation to how much you can close the gap. We can't just one day say, okay, even now we're still having a gap of about 500 basis points. We can't close that in one monetary policy or 1 year monetary policy. But as you close gradually, you start seeing how the economy behaves, and look at. So the threshold is also dynamic. It depends on the fundamentals of the economy, the shocks that we are facing. But like I said, 20 is not the best place to be. Coming down to 15, 12, and then coming to the single digits will be the best place we are looking at.
I wonder what year that will be. I'm looking forward to a year again that will have single rate inflation. We had it
2014
yes,
or 13.
2012,
Yeah.
2013, 14, we
Yeah.
had single rate inflation. Thank you very much for coming. I hope to see you again in January.
Thank you very
If
much.
we don't see,
Happy
Merry
New Year.
Christmas and Happy New Year.
Thank you very much. Thank you.
All right, that's the much you can take on today's edition of the program. Thank you all for joining us. Olayemi, I hope your question has been answered by Dr. Mahmud. I'll see you all again. Be the best you can be and be that change that you want to see by now.